Last week, Fed Chairman J Powell said interest rates will stay close to zero until 2022. Let's talk about what it means for us and how you can use cheap money to your advantage. Hey guys, what's happening? Welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, money management tips, and all things finance. If you're new to the channel, consider subscribing. In this video, let's talk a little bit about economics. Why do interest rates matter and how it impacts us? And if we ever get to negative interest rate, how does that work? Let's start with a simple question. Why mess with the interest rate? Why change? See, the Fed, or the central bank that control the interest rate, like the economy to be just right. Economic growth cannot be too hot or too slow. If it's too hot, it may lead to inflation, which is not good for the economy. In that case, the Fed will raise the interest rate. The idea is to discourage borrowing by making money expensive. If the economy slows down significantly, could lead to a recession, job losses, and negative economic growth. Not good. You will typically see lower interest rates and increase in money supply. Right now, the US is officially in a recession. Economy is slowing down, people are losing jobs, and things are not looking good. Major reasons why we are seeing almost 0% interest rate. Simple, right? Let's dive a bit deeper. When we talk about interest rates, it's important to understand the role of the central bank, or the Fed. There are specific reasons why the central bank exists. The goal is to manage currency, economic growth, unemployment, and inflation. Central bank uses expansionary monetary policy to stimulate the economy and lower unemployment, and contractionary monetary policies to counter inflation. Everything that you're seeing and experiencing these days are expansionary measures. The stimulus package, printing of new money, remember quantitative easing? And lowering the interest rate. The economy is in a recession, and these measures are designed to stimulate economic growth, which will push us out of the recession. I've done a few videos discussing recession, economic business cycle, and quantitative easing. Links will be flying in throughout the video. The Fed has two levers to pull to boost the economy: Fed fund rate and open market operations. Every bank has to meet the Fed's reserve requirement, meaning banks are required to hold a certain amount of money overnight. Typically, banks borrow from other banks to maintain the reserve requirements. The interest a bank pays to another bank is the Fed fund rate. When you hear that the Fed lowered the interest rate, they're talking about lowering the Fed fund rate, meaning the cost to borrow goes down for the banks. Since they are paying less in interest, they have more money to lend at a reduced interest rate. That makes money more affordable, so businesses are more likely to borrow and invest in their business. In summary, lowering Fed fund rate or interest rate encourages businesses to borrow, which leads to business investments and employment opportunities. The other lever is the open market operations, where the central bank will buy mortgage-backed securities and treasuries from its member banks to increase money supply. The greater the amount of money in an economy, the lower the corresponding interest rate. Lower rates allow banks to make more loans to you and I. Cheap money drives demand from businesses and individuals. It's a classic demand and supply play. When growth is expected to be strong, interest rates tend to go up because demand for money is more compared to supply. When the growth outlook is weak, few people are interested in borrowing and investing, and so the interest rates or cost of borrowing falls. What does all this mean for you and I? In a low interest rate environment, your cost to borrow will be low. For example, interest on your credit card will come down. Interest on car loans or student loans will be low. Now, mortgage rates are not directly tied to Fed fund rate. Indeed, mortgage rates closely follow the 10-year Treasury yield. However, when economy is expected to slow, you'll often see low mortgage rates. Indeed, mortgage rates currently are at a historic low. If you have a mortgage, it makes total sense to refinance. I just refinanced my 2 mortgages where I'm not only saving hundreds every month, but I also didn't have to pay any closing costs. Indeed, I got lender rebate, meaning lender paid me to borrow. I received cash to refi. So, no closing cost, no points, lowest interest rate possible, and cash in bank. Can't go wrong with that, right? Of course, all of this depends on your credit scores. Also, if you have a home equity line of credit or HELOC on your house, interest on HELOC will come down. On the other hand, if you're someone who saves and locks money in a bank or CD, expect to see a drop in yields. If you're a stock market investor, low interest rates favor the markets. The idea is consumer and businesses will increase spending, causing stock prices to rise. Simply put, money will be cheap for the next year or two, and you should use it to your advantage. The interest rate right now are close to 0%, and based on the latest from the recent Fed meeting, it will stay at these levels at least till 2022. There are some out there that are debating US should exercise negative interest rates. Sweden, Japan, and ECB have taken these measures. Negative interest rates are considered unconventional and drastic and employed when central banks fear major downturn and deflation. The way it works is the banks will be charged for any cash they hold. Also, when you and I deposit money in a bank, we may have to pay a fee as opposed to earning an interest on savings. The idea is savings either by commercial banks or consumers is bad and needs to be penalized. Central bank is literally discouraging savings and encouraging borrowing and spending. Indeed, consumers and businesses may earn money or other incentives just to borrow. There are pros and cons when it comes to negative interest rates. Profitability of banks will be impacted, and then who is stopping people from hoarding cash under their mattresses? Just saying. Fed Chair Jerome Powell is clear that this is not coming to the US. His comments, and I quote, "It's just not clear to my colleagues and to me on the Federal Open Market Committee that this is a tool that would be appropriate to deploy here in the US." That's all I have, guys. One final comment. Use cheap money, but wisely. Thanks for tuning in. If this was helpful, hit that like button. And if money gets you going, consider subscribing. Until next time, peace.